the state of the market. So we've included two charts here, which we thought were relevant for the staples sector. So the one on the left is food inflation. And you can see from that chart that inflation did peak in late 2022 and has been declining since. Obviously, a lot of noise around food prices and whether or not the major supermarkets are price gouging. But at the headline level, food inflation is definitely coming down. And hopefully, once we get the CPI numbers for December later this morning, hopefully that'll show another tick down as well. The chart on the right there is Australian population growth. And you can see from the chart that there was that slowdown during COVID, but population growth has picked back up now. And the importance of that is that as we get or as we have more people in the country, we also have more food that also needs to be consumed. I don't have any stocks that I think will positively or negatively surprise, but I thought I'd just touch on Woolies and Coles and also Wesfarmers and Endeavour. So on Woolies, the trading update on Monday was a bit softer than what we were expecting. It's about 2% below our forecast and about 1% below consensus. There were both positives and negatives from the update. So on the negative side, New Zealand Food and Big W earnings for the first half will be down materially. New Zealand is facing very tough operating conditions over there, while Big W is facing a slowdown in consumer spending, especially in the discretionary side. However, I think it's important to put that into context. New Zealand Food and Big W only account for about 10% of Woolies group EBIT, so it's not big. However, the other 90% of earnings, which is made up of the Australian food business or the main Australian supermarkets business, as well as the B2B segment, those segments are performing better than expected. So I think given that the Australian supermarkets business continues to perform well, that continues to underpin our ad rating on the stock. The other key question is, what does Woolies trading up down on Monday mean for Coles? In terms of read-through for Coles, I think that there were some slight positives from the update from Woolies. So firstly, Coles doesn't have a New Zealand business, and it also doesn't have a Big W equivalent. It's really just a food and liquor business. And I think given the solid performance of Woolies' Australian supermarkets business, it does also bode well for Coles. So on Wesfarmers, so the key thing to look out for here will be the performance of Bunnings and Kmart Group, given that both those segments make up about 75% of group earnings. If we go back to the AGM in October, management said that Bunnings sales remained solid, and that there was ongoing demand for repairs and maintenance, as well as smaller scale projects. And that is despite a bit of consumer cautiousness on larger scale purchases. I expect Kmart Group to also perform well, given that it does have a very strong value proposition, and given a weaker consumer environment, that should resonate well with consumers. So overall, I expect Wesfarmers to report a decent result. Despite that, the share price has had a really good run over the past 6 months or so, up about 17%. Still very much like Wesfarmers longer term. I think it should be a core holding in a portfolio, but I think given the run in the share price over the past 6 months, I will just hold off on buying any more at this stage and just wait to see what they say at the result. And then finally, Endeavour, the board changes that were announced earlier this month, I think are a positive, and hopefully, everyone can kind of get back to focusing on moving the company forward and looking to the future. But I guess the key question will be how much of the issues with the board, how much of that was a distraction for management in the first half. So we'll find out obviously next month. The other key thing to watch is that consumers are trading down in liquor. People are moving from craft beer to mainstream beer, and from champagne to rosé and prosecco. So commentary on consumer behaviour will be important. And on the hotel side, as always, gaming will be a key focus. We've got a hold rating on Endeavour. There is some uncertainty there on consumer behaviour. as well as some high potential for high costs. So just want to see how the result goes next month before reassessing things then. So back to you, Belinda.
Just on A2, we discussed that last week being one of our key buy trades this reporting period, because we expect a result that'll be much better than feared, that'll be much better than consensus estimates. We've told you that we've heard that A2 has handled the transition to the new GB standards well, albeit it's only early days. This management team continues to execute, and the A2 Platinum brand continues to win market share, which is clearly signs of a great and strong brand. In regards to the outlook, we wouldn't be surprised if the 24 guidance was upgraded slightly. We've talked about how the management team are highly incentivised with their package. They need to well and truly beat the guidance they've issued to the market. And then just touching lastly on two topical stocks. First of all, TWE. We are expecting a weak first half result. That's because Treasury Americas will be impacted by constraints with its luxury supply, whereas this time last year it had plenty of luxury supply. It'll also have higher COGS, and it will have the investment in 19 Crimes. Treasury Premium Brands will continue to be impacted by its exposure to commercial wine, which is in decline. And Penfolds will only report very modest growth, just given management's deliberate strategy to allocate more stock to the second half in hope that the China tariffs will be removed. So in regards to their 24 guidance, just given that skew of the second half, it's not without risk. And we've seen a number of luxury branded companies, a number of alcoholic peers downgrading their outlooks in recent months. And just on that Dow acquisition, clearly polarised in investors, but we're a buyer of TWE on the weakness, just given we see the removal of the Chinese tariffs, hopefully at the end of March, as a key catalyst for the stock. And lastly, a quick comment on Ingham's. Look, we wouldn't be surprised if it beat first half guidance. Originally, I was going to put it in the positive camp. It's just the share price has run hard. If they beat, then therefore we expect upgrades to consensus estimates. I note the stock has run hard, but if Ingham's can achieve anything like its 10% EBITDA margin target over the medium term, there is material upside to consensus estimates and valuations over coming years. And the grain prices coming off in recent months is a positive for their earnings. It's also, I think, been positive in the way that the stock's trading, with people mapping the grain prices against its share price.